So the way this is going to work, we are going to talk for the next 40 minutes on the clock, possibly a little bit fewer. Q&A, as you all know, you're getting used to this by now, will be at lunch. The folks who are available, unfortunately Brad does have to go, but the rest of the folks here, as well as all the other speakers from this block, will be available in the Aurora Ballroom A after the next session. So Brandy, I would like to start with you. You're the principal of GSP-REI. You've been helping GSP-REI, sorry.
Reno.
Reno Capital Management, I'm so sorry.
Yes.
Too late last night.
Yes, okay.
You're the principal of Reno Capital Management, and the last time we spoke to you, you help lots of folks with their multifamily lending.
Yes.
Last time we spoke to you, you were primarily focused on agency financing, but that market has shifted to a lot of bridge financing. Can you talk about what conditions have changed that have accommodated that, and how you're advising your clients based on those changes?
Absolutely. So we're seeing a lot more bridge financing in the multifamily space, partly because you can roll in and include in the loan, usually 100% of CapEx. And so, and typically when you can get more debt than equity, your returns will be better for your investors. And so, with Fannie and Freddie not really including CapEx, Freddie never did. Fannie is very particular now. They stopped the program that included CapEx, and then I guess it's slowly coming back. But with the market being so competitive right now, compressed cap rates, we're seeing a lot more bridge financing. And so last year, I think I did over $300 million in bridge alone. Yeah.
So I remember 4 or 5 years ago when we were having this conference, talk about the same things we always talk about. The only thing that changes are the conditions in the environment. Yeah. Everybody was afraid of bridge financing because it looked, when you were underwriting and trying to raise money, it looked more conservative to have 7-year fixed rates.
Yeah.
Now we're more comfortable with bridge financing in advising our clients because of the CapEx. How are you protecting against rate change?
Yeah, so, well, most bridge loans are going to require a rate cap purchase, okay, which we know if you're in the space and you've done bridge loans, you know that those rate caps have increased quite a bit, but they do protect you when you get a bridge loan in the event that the rate increases, which in this market, we know that that's going to happen because the Fed has already told us the rates will go up. So the SOFR, the LIBOR rates will increase. That may increase the spread, and those rate caps will help protect and hedge for any of that. So I'm advising my clients. I do it on a case-by-case basis because if a property still works on agency, I'm going to encourage them to do agency financing. It's just that with agency, we have to be at a 1.25 debt service coverage. It's, if that property suffered at any point during COVID with collections, the agencies are really tough right now to kind of get a loan done. There's a lot of auditing that takes place and a lot of red tape that takes place. So if I see anything that sticks out on that T12 that may raise a red flag and cause your proceeds to be cut or anything like that, I'm going to let you know up front and suggest that maybe we do a bridge until that property is fully stabilized.
Awesome. And by the way, I don't think I prepped these folks well enough. If you guys have comments, I see a look on your face. If you have comments, please jump in. I'm focusing on Brandy, but if you want to be part of something that Brandy said, please jump in. That said, with the interest rate caps, you said they've increased quite a bit. First of all, for the folks in the room who don't know what an interest rate cap is, can you explain what it is? And then for the folks in the room who do know what an interest rate cap is, can you talk about why it's increased so much? If you guys have an opinion on that, I'd love to hear it too.
Yeah, absolutely. So a rate cap is basically, the way I explain it is it's an insurance policy. So you pay for this cap that is provided through a third-party provider, and it protects you in the event that your rate increases over a certain number. And you can have different strike prices. Maybe your lender says, okay, well, we want a 1% strike or 2% strike. So if your rate increases over that 1% or over that 2%, then your rate cap will kick in and help with the debt service payment. So it's an insurance policy, that's what it is.
And why have interest rate cap prices increased as of late?
Well, increasing rates, inflation, everything that we know is going on in the market today. And so that's why they're increasing, because the rate cap provider is saying, oh, well, we know the rate is going to increase, so we're going to have to charge more for those rate caps.
Yeah,
Okay.
and to kind of comment on that just quickly as well. So on shorter term floating rate transactions, there's been a shift from LIBOR now to SOFR, which is the secured overnight financing rate. And ultimately, and that shift was pretty smooth. Everybody anticipated it. Yeah. But whether you had a forward LIBOR cap or now you have a forward SOFR cap, what those institutions are looking at as their pricing caps on their desks are forward curves, right? So when you look at the SOFR forward curve, SOFR today is at 0.05% as an index, which is extraordinarily low. However, when you look at the SOFR curve over the next year, the market is anticipating it moving up to about 1.8%. So again, over the last 60 days, you've seen quite a steepening of that curve. Over the last 2.5, 3 years, what was that LIBOR forward curve was really flat, right? So LIBOR cap pricing was much lower, but the increase in cost is just as a result of, as Brandy was suggesting, increasing rates and just how traders and those that are pricing caps are kind of looking directionally at SOFR.
Thank you very much, Brad. Thank you for assisting me with this segue. Brad Wilmot, Executive Vice President and Managing Director of Capital Markets at CBRE, very rich career at Goldman Sachs, institutional real estate lending, and now helps both institutional clients as well as syndicating clients with their debt across multiple asset classes, right?
Right.
Multifamily included?
Yes.
Multifamily included. I didn't know because I don't do multifamily.
Yeah.
But okay, so talk to us again, 30 seconds on what is SOFR, what is LIBOR, just for the few folks in the room who might need that. And then SOFR and LIBOR are typically used for floating rates.
Correct.
You have commentary on whether or not floating rates are going to move relative to interest rate increases from the Fed compared to fixed rate increases. Can you comment on the difference as to how floating rates might change versus how fixed rates might change
Sure.
with the Fed increases?
Yeah, happy to. So, LIBOR was, primarily the main floating rate index used over, the last couple of decades. There was really just a lot of noise around how some games were played around institutions, working with LIBOR, pricing LIBOR, taking advantage of clients. So a couple years ago, that was put to bed, and there was a transition at the end of last year out of LIBOR into another floating rate index. Most of the market has settled on SOFR, and SOFR is, a benchmark that has a lot of history in terms of being tracked. It wasn't readily utilized, but has now become, by and large, the replacement index for floating rate loans. So when floating rate loans are priced, you have the index plus a spread, right? So the SOFR benchmark is really tied to institutions, banks included, but even corporate institutions, borrowing overnight. So much shorter term. The treasuries, it's really the government borrowing from us, right? And borrowing from institutions. And so, what you have, both are going up, right? But with the anticipated Fed increases that are coming, and depending on who you read, is it 5 increases this year, 7, to be determined? But we're obviously anticipating one in March, probably another one in May, another one in the summer. And so with that, the market has moved, and the longer term rates, it's typically a 10-year treasury benchmark, has moved up. Also, what's happening currently with Ukraine, any kind of global market disruption is going to change the direction longer term of the treasury. The treasury is generally looked at as a safe haven, right? It's a little to be determined right now, but we're kind of in a weird spot, right, relative to some global disruption, anticipated rate increases. So just as an example, I mentioned SOFR is at 0.05%. Forward curve in a year is showing, a movement up to maybe about 1.8%. We'll see if that actually happens. The Treasury 10-year Treasury today is sitting at 1.99%, closed yesterday, right? That forward curve, the anticipation is the Treasury is going to move up to about 2.25%, right? But it's going to move upwards. But we'll see, if it drops a bit or stays around 2%, relative to where it was, the 10-year Treasury itself, 60 days ago, it's moved up 30 basis points.
That was very rich detail. Thank you for that, Brad. I kind of want to get a temperature check really fast. Show of hands, who knows what SOFR is? Okay, not bad. A little bit less than I would have thought. All right, so we might circle back around to some of that.
Okay.
John, you're on deck, but I want to ask Brandy one question before we get to short-term conversations. Brandy, we talked about some of the downsides of interest rates going up, like interest rate caps. Okay, higher upfront costs. Inflation sounds really scary, but yesterday when we heard from Spencer Levy, John Chang, Vicky Schiff, the punchline was, don't worry, be happy.
Yes.
So is there a good side of interest rate increases? What's the good, or of inflation, excuse me? What's the good, the bad, and the ugly of the core of the inflation argument?
I feel the exact same way. Multifamily specifically is a hedge for inflation. As rates increase, so does rent. So I think if you're in the right investment space, that you shouldn't worry.
Okay. How do you see inflation impacting cap rates and the spread between interest rates and cap rates?
So here's my theory. My theory is that right now we're experiencing compressed cap rates across most markets in the U.S. When inflation happens, when rate increases happen, I think that helps to stabilize things a bit. We've been on such a high uptrend for so long, and everybody is like waiting for the fallout to happen. Like, when is 2008 going to happen again? And we're over our 7-year, usually when it's every 7 years. So we're way past that cyclical time frame. So I feel like the inflation and the rates could actually help stabilize cap rates a bit. So it could be a helpful situation because you can only raise the rates so much before you raise them into a recession. And I know that's not the goal of what the government wants to do right now. So I think that it could possibly help stabilize things out over the next year or two. That's my opinion.
Okay, I see a head nod up and down. Would you, for the most part, agree? Any contrarian input? And then I am getting to get to you, John.
So no contrarian input, but just generally with rising interest rates, you're going to see at some point a rising cap rate environment. That's just natural. Cap rates rise in probably 6 to 9 months relative to any interest rate rise and full coupon rise. That being said, there's so much equity today that's being deployed, whether it's private capital that's being syndicated, whether it's institutional capital, and going into major asset classes, particularly multifamily, industrial, we're seeing it in self-storage. Just that demand side of the equation, money needs to be put to work, which is certainly going to help temper cap rates. When you're talking about the spread, Treasury or some sort of underlying index to the cap rate, you still have in most aggressive terms, let's say you're buying something for a 3.5–4% cap rate, that's 150 basis point spread to 200 basis point spread today over the underlying index. When you look at that today relative to pre-financial crisis up to 2006, 2007, that spread at one time was 75 basis points. Okay, and the reason why is because not only was there a lot of equity, but there was a lot of over leveraging of assets in the system. As Brandy pointed out, right, we're kind of past that 7-year mark, right? And that's
almost
because
double.
Exactly.
Yeah, almost.
And that's because there's been tempering as it relates to leverage and underwriting. Exactly. But what I would say as it relates to rising cap rates, it's something that certainly has to be, considered when you're investing today, what are you buying for? Really looking forward on your exit, how long are you going to hold a particular asset? If it's 3 to 5 years, the suggestion would be model a higher cap rate realistically today because cap rates are going to go up. And I'm sure you're seeing that as you're underwriting, just loans on your side, but both of you as you're seeing with your clients and how they're looking at their investment horizon.
Yeah, I'm seeing a lot of incomplete business plans and more sales happening due to cap rate compression. You know what I mean? So I think that we're going to see a transition from I'm selling this asset because of cap rate compression to I'm selling this asset because I completed my business plan and now we're here and it's time to sell. And so I agree 100%.
Awesome. Thank you guys for that exchange. I really appreciate that. I want to switch gears a little bit. John, you are the director of lending with Aloha Capital. You've got a rich background in underwriting, specifically in restructuring difficult stuff. You've seen some hairy things happen. And now with Aloha, when these guys think about short term, they're talking about bridge loans that could be 3, 4, 5 years even sometimes. For you, short term could be like 9, 12, 15 months. So how does inflation affect interest rates in your world? And before you answer that question, can you describe your world to us? Why you're playing around in 9, 12, 15-month loans?
So we're in the private lending industry, so we're much different than bank lending, agency lending. Our capital is sourced from different areas, and typically we're dealing with lower credit deals. We're higher interest rates, shorter loans, there's capital expenditures involved, there's deferred maintenance, low occupancies, things like that, But to address your question, in the short-term world, we're actually not really seeing an expansion in rates right now. Weirdly enough, our long-term loans have seen a 75 to 100 basis point increase in the past 3 months versus our short-term loans, which are bridge loans, have slightly compressed.
Did you say compressed?
Yeah, slightly.
And gone down, right?
Have gone down like 25 basis points, weirdly enough.
Any reason why? And when you say short-term, what's that time frame?
It's like 9 to 12 months probably.
Okay.
Sometimes 24 months. I think it's generally due to just the product itself, right? It's meant for repositioning assets. It's meant for funding capital expenditures. It's meant for, construction. It's not meant to hold a stabilized asset. It's not meant to be a long-term investment based on cash flows.
Is it because more money, the investment money behind the loans are just shifting to the short-term stuff to kind of hedge and get the last squeeze on certainty before expected changes? Is that the thought process?
That's probably has something to do with it. We saw an extreme drop in volume for bridge lending when the pandemic hit, and the lack of inventory has really kept that volume down low. And I think the refi boom really pushed people into stabilized assets and pushed people out of the bridge lending world. But as rates increase, the refi boom ends, money starts flowing towards the bridge lending world. People start looking for assets they can reposition. They start looking for good deals in the value add space. And the market makers in my world are seeing that, and they're trying to capture that volume. And in general, that means lower buy rates, lower pass-through rates, lower rates in general to the clients.
Awesome. All right, so we're 20 minutes through. We've been talking about inflation and interest rate. I want to switch gears a little bit and get inside the head of an underwriter. Things have changed a little bit, right? So since pre-COVID, I mean, that's who you are, right? You're an underwriter. Since pre-COVID, what has changed about the mindset of an underwriter originating a loan? When we're going out seeking loans, what should we be thinking about when we're trying to get into the heads of these underwriters?
So the first 6 to 10 months of the pandemic really threw everybody for a shift. Underwriters kind of sat on their hands. There wasn't really a lot of volume. People just kind of sat there. Margin calls were killing the entire market. People were saying 50% delinquency rates on portfolios, and people were buying billion-dollar portfolios or trying to sell them at like 90, to par. Really what we saw is what, at least in the multifamily residential spaces, it wasn't as bad as it really seemed. Delinquency rates did not crash. We didn't see the crazy amount of defaults, NPLs coming into the market. There was probably, as Brad alluded to earlier, there was probably a pretty strong credit in the markets, in the underlying markets going into the pandemic, which probably kept all of these things afloat through the problem times of the 6 to 10 months. So I guess really like what I look at when I underwrite a deal nowadays compared to pre-pandemic was, what did the asset do? What did the borrower do during that crazy COVID time in 2020, a little bit of 2021? Like, what did they do? How did they pay? Were they going into forbearance? Were they doing anything that was taking advantage of the systems that were at play? Because there was plenty of people doing that. Did they pay on time? Whatever, But besides that, I think the metrics are still the same. You still base it on the asset's performance, the cash flow metrics. You base it on the borrower's experience, their ability to service the loan. I don't really look at cap rates or market performance over the past 12 months as much as I used to, just because when everything's 20% year over year, it's kind of hard to use that. You kind of have to compare it to the national average. But I do like to look at population growth. I like the demographic data. I think that's a good kind of way to take the financials out of it. But I think really, underwriting hasn't changed much since pre-post.
Okay. Brandy, I want to ask you a similar question. You're focused on larger multifamily, and you're coming in from the lens of advising your clients as opposed to doing the underwriting yourself.
Yeah.
So from a business perspective, what's the box of terms that is helping get the most deals pushed through successfully? And let's stick to the good ones, not push the deals through that shouldn't be pushed through, but are just presenting the good deals in the best possible light. When you're presenting your deals to the originators at the lenders that you work with, what do you know they're looking for that you highlight?
So especially on the bridge side, they typically want to see populations over 100,000. They want to see a debt yield, which is a calculation of cash flow over 5%. If you want to get the best terms, they typically like to see underwriting that's not too aggressive. So I tell.
What does that mean? Not aggressive.
So do not send me a pro forma with a 20% rent growth every year. Because
what about just 2 years?
No.
No, fine.
Do not do that. Do not tell me that you're going to take over a property, and in the first year you're going to have like this exponential income situation happen, And so I tell my investors all the time, make sure you are conservative in your approach, not only for me as your broker, but also for your investors. And so that's being conservative on the interest rate that you may get going in, conservative on your pro forma and your expectations, making sure that you're working with a property manager who is also conservative in their approach and who has experience in that market. So that is my number one piece of advice: is never approach a property being very aggressive in what you think you can do with it.
What about appraisal risk?
Yeah.
So with values changing so much, in the storage space, 85 basis point compression in 6 months.
Mm-hmm.
And appraisers are using 6-month-old data. How do you protect against appraisal risk? They have too much power today.
Yeah, the appraisers do have a lot of power. But what I am seeing, especially in the smaller markets, is the appraisers pulling back a little bit. If you're acquiring a property that does not have comps that support your business plan and what you're purchasing that property for and what you're saying that value is going to be in 2 years and 3 years, we're going to have a hard time getting that deal done. And I've dealt with it before, and then we have to go to a lender that's willing to take the risk, which means more risk, more rate, more interest reserve, and it could get very expensive. And so my clients now know that if we're going into a specific market, depending on the market, like if it's Dallas or LA, That's different, right? But if it's a smaller market or more tertiary market, we need to have comps that support, because the appraiser has the last say, and if they cannot find anything that supports what we're saying this is going to be worth without aggressive rent growth calculations, we're going to get a cut.
So you know this well because you and I had this exact problem on a deal.
Right.
How much are lenders going back to basics or getting away from basics? Actual asset quality assessment, like being boots on the ground, picking up the dirt, seeing the quality of the asset. Are they getting farther away from knowing how valuable an asset is, or are they getting closer as this economic cycle evolves?
I think that they're getting closer, frankly. And you know, it's not just how does an asset look when you do a Google view, right? It's really more boots on the ground and what's the asset quality, what's the market environment, what are the characteristics of a given market. And lenders are very much focusing on that. There are certain lenders, certainly, that are willing to take more risk for what are, you know, perceivably more challenging assets, as long as there's a good business plan, right? Yeah. Other lenders shy away from maybe taking more risk on assets that tend to be a little bit more challenging. And not challenging doesn't mean bad, but maybe a smaller market needs a lot more CapEx, or again, needs just a greater business plan in general. However, given there's just so much capital out there, so much debt capital. I mean, we at CBRE, we placed over $60 billion of loan transactions last year with over 350 lending institutions, so very small to very large, right? And what we find is that there's a home for any kind of loan. Part of it is what's the leverage point, secondly, what's the price, right? Yeah. And again, then, you know, at the end of the day, is it a lender that you want to work with or not? But there is very much a focus on kind of all the aspects of a given transaction or set of transactions by lenders. And there's so much information available. As Brandy was saying, I mean, you know, lenders are going to want comps, sale comps, rent comps, sometimes expense comps. In our case, you know, sometimes it's if pricing on a particular asset, let's say it's an acquisition, is at a very low cap rate, seems extremely aggressive to appraise out, you know, oftentimes, and I'm sure you've experienced the same thing, you have to have the investment sales broker come up with a list of bids that came in and what that environment is. You know, realistically, there's so much information out there. No investor is going to truly overpay for an asset. That's a market level price today, yeah. Right? So as long as you have the support, as long as you have the facts, and you can make a fact-based argument and case to a lender, it might not resonate with every single lender, but you'll find the right group of lenders or a lending institution that will ultimately, I think, have conviction and ultimately, you know, get their arms around an opportunity.
Awesome. So I want to put you on deck to talk about equity in just a second. But John, I want to throw you a curveball question.
Okay.
So some of the conversations around blockchain are about metaverse worlds and duplicating our physical space in the metaverse. I'm not going to ask you to talk about blockchain. It's okay.
Okay, thank you.
But I have heard of 3 companies that are selling space of existing assets in the digital space, which is a whole nother like trademark issue that we'll maybe talk about next year. My question to you is, do you ever see yourself from an underwriter lens not going to an asset, just putting on an Oculus headset and learning everything you need to know from your living room?
Definitely, because we've closed loans plenty of times without actually having boots on the ground from our company.
Okay.
So I think technology is to the point where you know, pictures and videos are sufficient.
So where Aloha concentrates, I feel like volume is a larger concentration than perhaps like a $100 million deal. If you were to sit in the seat of doing a $100 million deal, would you make the same underwriting decisions with an Oculus headset on?
No. I would never do that.
You would never do that?
No.
Never?
On large balance deals, I would always have someone from the company, you know, walk the property. It's just, it's worth it. It's worth the money spent for traveling, whatever. It's 100% worth it.
Okay, and just to predict from a generational standpoint, millennial, yeah?
Yeah, I guess I'm millennial, yes.
Okay, all right. So we're not seeing that change anytime. You're not 10 years from now.
No.
All right.
No,
Somebody's not going to hack my digital space and show like butts drawn on my storage facility, and that's what you're going to be like. Oh, broken Windows concept, not going to lend.
No, you're talking to a conservative underwriter, so I'm never going to be at that point in my life. Maybe, I don't know. Talk to me in 10 years. Maybe.
Okay, fair enough. Fair enough.
Yeah.
All right, Brad. I want to talk to you about equity because I know you also place equity. Can you tell us about the equity landscape? How much was out there during COVID? How much is out there now? How has it changed the volume of dry powder?
Sure, happy to do so. So just to kind of give a current view, there's about $300 billion of private equity capital, and when I say private, that's really institutional private equity, right? Out there, the Blackstones, the KKRs, et cetera, to invest in commercial real estate, and this is mainly a focus domestically here in the United States. You also have pension fund money, and that's several $100 billion in addition. Pension funds have been, an investor more in fund form, not direct asset form, into commercial real estate. But with how just the stock market has and the fixed income market have performed over the last year and a half, those portfolios, pension fund portfolios on their equity and fixed income side have performed quite well. They have to have a certain allocation into other asset classes. And typically pension funds will invest of their capital, they'll make an allocation between 8 to 10%. So you have more pension fund capital coming into the market today as a result of very positive performance in their equity and fixed income portfolios. Then you have foreign capital as well. And again, you've had the sovereign wealth funds, you've had Canada, you've had money over in Asia that has come into the United States being, again, as a country, a safe haven for commercial real estate assets. Now you have, in terms of what's going on, you have currency factors to take into consideration, and the way that foreign investors will look at their investment, it's not just do they want to get a certain return, certain cap rate, certain rate of return in investing in a particular asset or set of assets domestically. There's also now an exchange rate consideration to take into consideration. So with that, if there's a view that there's a positive exchange rate that's actually in their favor, they'll want to invest for at least a period of time more money into U.S. assets. So you really kind of have on an institutional basis those three factors. And so you have, again, depending on what you read and who you hear, you have well over $500 billion of equity capital that is available to deploy in commercial real estate really just this year. It won't all get deployed this year, but it's out there. So a lot of demand, right? And again, that demand factor from an equity side is helping, as we talked about cap rates before. Again, interest rates are pretty low still, historically speaking. It's keeping cap rates down in those favored, property types.
So I know you have conversations with people at some of the biggest shops, and a lot of the people in this room, when they're seeking yield, they're not buying in downtown Denver. I'm not buying in downtown Denver. This is not a downtown Denver investing room, for the most part. There's some of you out there. For the most part, we're in secondary, tertiary, even moving on into rural markets. How is that 50 trillion? Is that the number that you just said? $50 trillion?
No. Over half. Half a trillion.
Half a trillion.
So over $500 billion worth of equity.
I'm going to blame the party again on that one last night.
No problem.
So over $500 billion
Thanks
of
for
equity.
clarifying.
Yeah, thank you. Over $500 billion of equity out there. A lot of that's coming from some of the biggest shops. With the difficulty of deploying it, especially with the conversation that we had yesterday about not as much selling opportunity for the brokerage firms, are they pushing their yield search farther outside of the primary metros?
Absolutely. Yeah, absolutely. So whether it's certainly you've seen over the last, 2-3 years, early pandemic time frame wasn't so much, but after we kind of cleared through several months, it just had to be, to deploy that kind of equity, a focus on solid secondary markets as opposed to just the primary market. So it's really now the top 50 MSAs versus the top 25 MSAs. And again, those institutions have to put their money out. That's how they get paid, right? They earn fees, they earn yield, and so at the end of the day, they have had to widen their search, which is then translated to, compression or decreasing cap rates in the secondary, even some of the tertiary markets. And the institutions are actually considering tertiary markets, not for individual assets, but if there's a large portfolio that they can acquire, which includes some assets that are in tertiary markets, they'll consider that. They'll consider then, upon acquiring, how do they spin out and how do they sell off the assets in tertiary markets so they're not on their balance sheet for a long period of time. But that's happening as well. So then, it translates to what we've seen, a bit of a compression of cap rates in tertiary markets. So again, it's just this, volume of equity that is really kind of, keeping things, again, very aggressive on the cap rate side of the equation.
Okay, so just to make sure we're all benchmarking off of the same cities, what's a secondary city, what's a tertiary city? Just to clarify that.
Yeah, so I would say, let's say, for example, Charlotte, right? Nashville, secondary cities. Great areas, population growth, income growth, good metrics, but let's say Charlotte, particularly for East Coast-based, New York-based investors, those particular cities, just as an example, weren't in favor necessarily a few years ago. They've now very much become in favor because they've performed well, right? And as was discussed earlier, investors will look at areas, as it relates to population growth, income stability, et cetera, and there are good metrics around that. So again, what was, a secondary city, which those are very favored secondary cities today. Tertiary markets are going to be smaller markets that maybe have populations of 10, 15,000, 30,000. That will be viewed just from a metric standpoint as tertiary as opposed to, secondary markets that have somewhat larger populations.
Awesome, thanks for that. Okay, so you guys know how when you go on kayak.com, it gives you that little predictive thing that's definitely trying to mess with your head about when to buy your plane ticket. Yeah. It's either wait or hold. Right. When it comes to acquiring debt for your deals, are we in a, wait or hold. Are we in a wait or buy now situation? Go get the debt right now for your deals or wait 30 days, 90 days? I just I typically hate the rundown questions, but I want to just hear what each of you have to say. Brandy, you first.
Why wait?
Why wait?
Do it now.
Like the great Bob Fraser said, borrow money, buy shit. Okay.
Yeah. I mean, do it now. I mean, we see the rates are increasing, but that's not really why I'm saying that. I just think the market is great right now, and investing in certain asset classes can protect you later on. I've been through a down market personally. I know what it's like. I've been there. So diversify, invest, and put your money somewhere other than in a bank.
Awesome. John, wait or buy now?
I would buy now. If you're buying in a stabilized property, similar reasons that she stated, the rates are pretty low still, like Brad said, historically. So I would buy now.
Okay. Yeah. Brad, wait or buy now?
I would absolutely buy now. And again, historical context, right? You look back and last year, you could finance certain assets anywhere from the high 2% coupon range up to, let's say, 3.5%, 4%. Today, that's moved, and you're probably looking at very low 3% it's very situational, low leverage life company financing. It's really 3.5 to 4.5 to maybe even 5% market today, and that's given the run up in the underlying treasuries. Spreads have also widened. Okay, so that being said, on a historical basis, interest rates are really low, and you can't try to capture what was. Right. If the deal works today, if the interest rate works today, I would definitely take it today. The anticipation is rates are going to climb a little further, so things are going to get a little worse. we can't predict where rates are really going to be. We can try. If we all could, right? If we could predict, we wouldn't all be sitting here. We'd be on a beach because we'd be, set. We would have made that trade and we'd be out of the market, right? So if, bottom line, if it works today, I would say buy now.
Awesome, thank you guys. Brandy is giving away a MacBook Pro and Titleist golf clubs at her booth right there if you want to have a conversation with her right after this. John is at the Aloha Capital booth right over here if you want to have a conversation with him. Both of them will be in the Q&A room after the next session right behind us. And Brad, unfortunately, is leaving us, but maybe you'll be lucky and you'll catch him for 5 minutes and he'll give you a 301 class on some capital markets. Round of applause for all these guys. Thank you so much for your time.